and welcome back. In today's video, we'll be talking about mortgage insurance premiums, or MIP, and how that relates to FHA loans. So let's get started. So let's talk about what is FHA. So FHA stands for Federal Housing Administration. So the FHA was created in 1934, and it is another sub-agency within the U.S. Department of Housing and Urban Development, otherwise known as HUD. So now the FHA, in order to provide housing for Americans, does this thing where it provides mortgage insurance to specific lenders in order for lenders to accept people who are less than perfect credit scores and have a lower amount for a down payment. The idea is that these mortgages, which are backed by the government, allow for lenders to be more flexible, which then allows more Americans to have homes. How does the FHA mortgage insurance work? So like I mentioned before, the purpose of having FHA mortgage insurance provide on FHA backed loans is the fact that it protects the lender. Again, mortgage insurance in this case does not protect the borrower, it protects the lender. So how it works is that if the borrower defaults on a loan, which means that they do not pay for it, then when the house goes foreclosed, if there is a loss towards the lender side and the home sold for less than what the original loan amount was for, then the lender can file a claim with the FHA to make some of that money back. Again, remember that the mortgage insurance does not protect the borrower, it is for the lender. How is FHA mortgage insurance paid? Well, there's actually two types of FHA mortgage insurance. So let's cover the first type. The first type is the upfront mortgage insurance premium, otherwise known as the UFMIP, is a one-time payment made at the closing of the home. Now, the UFMIP can be paid in cash or it could be included in the finance charges. Generally, the UFMIP is required in almost all FHA-backed loans. However, there are some exceptions. Please see your loan mortgage originator for additional clarifications for your specific circumstances. Essentially, just note that if you are financing your UFMIP, then you are also paying for it with interest because it is rolled into your entirety of the loan. It's also important to note that the UFMIP is not refundable, even if you sell the house or pay off the loan. So how is the UFMIP calculated? Well, there's a couple of factors that are tied to how much this initial premium is going to be. The first is, what's your total loan amount? The second is, how long of a term is that loan? And the third one is, what is your loan to value ratio, otherwise known as LTV. So the LTV ratio broken down is your loan divided by the appraised value of the house. The higher the loan to value, the higher the UMFIP can be. 2. The second part of FHA mortgage insurance is what is usually called the MIP, which is the annual mortgage insurance premium, and this is what gets paid on a monthly basis. So let's break it down. So when you have an FHA loan, every year of that loan you will have a mortgage insurance premium, but although it's an annual mortgage insurance premium, they break it down to you in monthly installments and tie it to your mortgage payment. Like the UFMIP, the same three factors affect what is your MIP. So again, it's your loan to value ratio, the loan amount, and then your term. How is FHA mortgage insurance different than private mortgage insurance? Well, one is applicable to FHA loans and one isn't. FHA mortgage insurance is applicable to loans that are from FHA. Private mortgage insurance is usually tied to conventional loans, which if you need to know more information about PMI, check out this video. Also, there's a difference in the removal across the two. In FHA loans, if you paid for your house with a down payment of less than 10%, after 2013, you will actually have to have your MIP for the entirety of the loan. Unlike PMI, which automatically gets removed once you have 22% of equity in the house. That is not the case for FHA. Another difference is that if you did pay more than 10% as a down payment for an FHA loan, then your MIP will be at least mandatory in most cases for a minimum of 11 years out of your mortgage term. And again, it can vary dependent on the particular term, so make sure you talk to your lender about that. All right, so that's the general basics in regards to an FHA mortgage insurance. If you have any questions, please leave a comment below. Do me a favor, give this video a like. Make sure you are subscribed if you aren't subscribed already, and if you could share it with somebody who might also need this information. As always, here and happy to help. If you do have a question that I don't know how to answer, I'll let you know I don't know the answer, try to find the answer, and then let you know how I came up with said answer, so that way in the future you know how to go and look for the answers yourself. And as always, I hope you have a great one, and I'll see you in the next video. Bye!